Everyone, welcome back to another episode of AQ Markets. So today's topic is going to be what I wanted to discuss on Monday, but then we had the whole fiasco in the oil markets, so I put this on hold. But today's topic is going to be what is an ETF and how does it differ from stocks, and let's see if it's a good investment for you guys. So an ETF stands for Exchange Traded Fund. And what it basically is it is a security that we could trade in our typical brokerage sites. However, it is comprised of other securities. So that sounds a little confusing at first, but think of it this way. You could buy a basket of stocks instead of just buying one. But the best part about it is it doesn't just contain stocks. In some cases, there are ETFs that are comprised of bonds, there are ETFs that are based on commodities, and there's even ETFs that are focused on different currencies. So the best part about ETFs is that it gives you exposure to multiple things at the same time. Now, just a quick example, if you believe that airlines are going to make a really good recovery after COVID-19 runs its course, and it's a thing of the past, hopefully soon, then instead of picking and choosing which airlines you think are going to do good, like American Airlines or United or JetBlue, and you're afraid that maybe one of these might actually end up going bankrupt and you lose all your money on the stock that you purchased, then the best way to avoid all that hassle is to buy an airline ETF. An example of that would be Jets, which was featured in my first video. And additionally, when you have certain securities that are very difficult for typical investors like us to get into, for example, corporate bonds, there's an ETF for that. So with corporate bonds, typically you have to trade a really high dollar amount, and it's very difficult to get through as just an individual as opposed to being a corporation or an investment firm. We can actually buy ETFs that are formulated with the underlying securities being bonds. Another thing too is, as I mentioned in my previous video, if you want to gain exposure to commodities and futures contracts with those commodities, there are also ETFs for that. The way that ETFs are managed is that there's typically a portfolio manager or a team that works for an institution or an investment firm that manages the ETF. Now, in return for managing it, they do charge a fee. So that is the small downside to owning an ETF, is that you will have to pay to own it over time. However, it's not as crazy as people think. The average cost of an ETF is 0.44%, 44 basis points, which really isn't too much. For example, if you're investing $1,000 in an ETF, that's just $4.40. So there's two types of ETFs. There's an actively managed one and there's a passively managed one. So first, with the passively managed funds, those are just straight up, hey, you want to buy into airlines, then here is an ETF that has all the airlines. You want to buy into the SP 500, then here's an ETF that has every single stock in the SP 500. There's nothing complicated, it just gives you the accessibility to be able to do something like that. So when someone tells you you should buy the SP 500, the way to do that is through an ETF. Now, the actively run ETFs are a bit different. Typically, this portfolio manager has an investment thesis with an underlying index or an underlying commodity or whatever it is. But they're going to be a lot more aggressive on how they construct this ETF. So there's a lot of ETFs that are focused on the S&P 500, and the actively managed ones are going to basically change their allocation towards these 500 stocks, pick the ones that they think are going to do better over time, allocate more money towards it, and in some cases short the ones that they think are going to be doing really poorly over time. So what their main goal is to outperform the S&P 500 over time. They want to do exponentially better than them, and that is what justifies you wanting to purchase them, because the main difference is the price point as well. So with passively managed funds, they typically have the average cost of 44 basis points, sometimes 25 basis points, but the actively managed ones are going to have slightly higher expense ratios because in the long run, when they're outperforming, there's a lot more work behind that. I myself have worked in an active fund, and it's very challenging, it's very difficult, and there's a lot of grueling hours that go into trying to figure out what is going to outperform. So let's talk about the pros and cons when we're comparing a stock and an ETF. So the biggest reason that I like ETFs is because they're overall less risky. And I say that because going back to my example with the ETF Jets, if I believe that airlines are going to do well, then I could purchase Jets and have exposure to everything. Someone else who wants to do it the route where they invest in key companies, they're going to be buying American Airlines, they're going to be buying Spirit, they're going to be buying whatever they think is going to be doing well. Now, assume we're both wrong, and let's just say that the person who had the ETF had some bankruptcies in the airlines. The thing about the ETF is since they only have exposure to certain companies, if an airline goes bankrupt that is within the ETF, the whole thing doesn't fall to zero. You're going to be losing X percentage. Let's just call it 3 to 5% depending on the allocation. Now, for someone that owns the stock, if the stock goes bankrupt, you lose everything. And if you're constructing a portfolio of just 3 or 5 of them, then you could lose easily 20 to 30% of your whole portfolio. So risk is the #1 reason that I like ETFs. Now, when we compare the cost of owning, it's a little bit complicated because with the ETF, we do have to pay the expense ratio, which is the fee that goes to the portfolio managers. So that's one small con. As far as a stock goes, typically when we're buying these high quality stocks, they are paying dividends and they will pay you over time. So there's no cost, and in some cases there is a net positive. However, there are certain ETFs that focused around dividends. And you could buy ETFs where their main focus is to buy the high-paying dividend stocks that are within a certain subgroup, or even ones that show increasing dividend payments over time. And of course, those get eaten up. So if you're buying dividend ETFs, it kind of really doesn't matter. But if you're just buying basic ETFs that don't pay dividends, then you are going to see a gradual decrease of your potential earnings. But as I mentioned before, for me, risk is the #1 reason why I like ETFs. As far as accessibility, they're the same. For the most part, you can buy and trade all ETFs where you can buy stocks. The only limitation that I know off the top of my head is if you want to buy a leveraged ETF, certain brokerages won't let you do that. But that really isn't a big deal because as intelligent investors, we should probably stay away from leveraged things unless we're very, very sure about that. So now the real question is what is best for you? And that is quite a debatable question, and it really comes down to comfort levels. But ultimately, if you are a new investor or you're a bit unsure of how to pick stocks and what makes them tick, then ETFs are definitely the best play. They are much less risk. It gives you exposure to many different stocks, and over time, they will be growing. If you are someone that actually works in a specific industry and you know the industry very well, for example, I have many friends that work in IT and technology. They understand the tech space better than me, better than anyone that I know. So they can kind of see certain key companies that will outperform in the long run. So if you're in a specific industry and you know the industry well, I would go pretty heavy on the stocks that you understand. Now, for the average investor, I would stick to ETFs and construct portfolios of different industries and different commodities just so we have exposure to everything. So that concludes my discussion on stocks versus ETFs. As I mentioned, I am pro ETF, but when I see an opportunity in stocks, then I will definitely jump on it. If you're an expert in an industry, buy the stocks that you know are going to do well. And if you're just a casual investor that wants to build wealth over a long period of time, diversify yourself in various ETFs to ensure that you are getting exposure to every single industry and you're not going to miss out on an opportunity. Thank you very much for watching. I hope this was super instructional, and I hope it gives you a little bit more of an edge when you're investing now. In my description below, I'm going to be adding a list of a few ETFs and what they're comprised of, just in case you want to check out certain industries or certain indexes that you find interesting. If you're curious to know if an ETF on a certain industry or concept exists, please leave a comment below. I will get back to you as soon as I can with hopefully an ETF that will be relative to your question. And I'm looking forward to the next video. Thank you so much for watching. Take care.